going to go ahead and assume that we are coming in hot at this point. Welcome to Freightonomics. We're ending the month of July. It feels like July 50th in terms of all the activity and action that we have. But Zach Strickland, head of Freight Market Intelligence, Thomas Wasson.
Namaste.
Does a
Trucking
lot.
analyst here. FreightWaves.
I don't know. You're the new host of a lot of things too.
Get around, you just whatever shirt. I'm gonna wear a shirt each day so I can see what I've been up to.
But big show today. We've got a lot. We only do Freightonomics twice a month now, as things, of course, get more economically active. But we've got a lot to cover. We've got a combination of tariffs. The Fed just had an announcement. We have a bunch of earnings going on as well. Earnings season, a lot of reports there. The freight market, a little bit of the doldrums here in July. So it gives us a little room to work with on some of the things that are going to influence the freight market when it does have a little bit more reason to be responsive, economically speaking. And if you are not, I think a lot of people out there, especially myself included, when we were working in the space, kind of put on blinders to the world. We kind of were like, we're going to focus on our business and what we have here, and that's generally the right move. However, I think the world has changed enough, and that you can't ignore it. You can't ignore what's going on outside your walls anymore. I think that's become more and more necessary in order to make sure that you can operate your business at this point.
Can't be in your own little hole anymore. It's almost, you got to start paying attention to a lot of broader trends. We're getting buffeted by so many macro factors that, hey, speaking of which, that's why Freightonomics is here. So
I know.
Y'all are in luck.
Yeah, guess what? You got 26 minutes. We'll get you up to speed and you can go about your business. But yeah, I think one of the things that I've noticed here is that, in the trucking world, you used to just say like, well, it's July. Or, well, it's produce season, or, well, it's, this happens in cycles. This freight cycle that we're in has lasted for over 3 years in terms of a relatively down, soft market. And now, of course, the economic environment, post-COVID, we'll call it, has been more and more erratic and volatile and harder to read, meaning that the freight market is operating in a turbulent sea itself.
We're almost in like the freight market purgatory because, there's some commentators that say the macro fundamentals are strong. There's some saying that it's actually, there's hidden rot underneath. And so when you're looking at the trucking market, it's been depressed for so long. And the freight stuff, we've been thinking, oh, well, I need some of that good news over here. Because if you're looking at, like you said, Q2 earnings and stuff, we continue to see this deterioration in the market, and it's being impacted by these macro fundamentals. And so it's definitely kind of a two movies on one screen impact, because when we're looking at talks about these macro things, and we're going to be diving into that in a minute, it still feels really rough if you're in the trucking space.
The trucking space is still suffering from a lot of stuff. But guess what? A lot of these other sectors are also going through a lot of tough times. Coming out of this pandemic environment, I think we've forgotten, we've kind of dismissed a lot of that and pushed it to the past. Yep. We're still dealing with what was an overheated economic situation that has cooled off dramatically. And it's influenced housing. It's influenced a lot of these tech company business models. Microsoft, huge earnings. But guess what? It's because they cost controlled and laid off 9,000 people for the most part. So it's not just limited to trucking, even though it feels, it can feel that way. Most of the economic growth from a lot of these companies, especially the larger ones who can weather this type of environment more so, that's really a big thing that the pandemic era has created. These overheated economic cycles really push inequity, not just in the low income and high income areas, but also throughout like businesses, like large businesses, small businesses have also, had a growing divergence of experience there and how much they can tolerate, especially when we're talking about tariffs and supply chain. So let's get things going after that long-winded introduction with a market in two, so we can start off with some data and get this going. So kick it off. All right. First chart here, OTVI, the measure of truckload demand, really soft coming out of the July 4th holiday period, and it continues to be this way, really underperforming last year, about 14% down year over year at this point. A lot of this, and I'm going to show you in a chart here in a few minutes, or less than a few minutes, going to intermodal, but I still see some economic deterioration here, very flat, stagnant demand side environment. However, I've got some good news for you, truckers. Tender rejection rates are still remaining elevated. We're still up above year-over-year values. So demand's down. Capacity's actually held on to this tighter level of, tender rejection rate, which is above 5.5% still. And we're maintaining above last year, even though we have significantly lower demand. This is not meaning that the market is tight. It just means that it's less loose than it was this time last year on lower demand. Still a very good sign moving forward. So the next chart, spot rates. Spot rates are about flat. I like the rejection rate here better than the spot market, even though we do see some underlying inflation in the overall spot rate, excluding fuel. This is NTIL. But rates much more responsive than we've seen. Road check week and July 4th both had sharp increases, but followed by pretty rapid deterioration as well. So this market just isn't quite there to have a sustainable flip. Let's go to the next chart, talk a little bit more about demand, expand on that O-rail. Loaded container volumes up 2% year over year. Truckload tender volumes down 14%. Like I said, this is not a net wash in overall demand, but a lot of that long haul freight continuing to go on intermodal freight. Let's finish things off with the IOTI, which is the reason why the intermodal volumes are so strong. A lot of this container freight coming in over the ocean. You see that early season peak that is now kind of washed out a little bit, but still maintaining a decent level of import activity. This is also one of the reasons, as we're going to talk about here in a minute, why we just had GDP outperform a lot of people's expectations.
And that's one of the big things that we're thinking about here is that that interplay between not only rail, intermodal, and maritime. This is really bringing to light just how complicated our system is. And so I think a lot of people, when they're trying to understand and read the tea leaves, it comes on a boat, it gets on a train, and maybe it goes on a truck. And then that's kind of what we're parsing through right now.
Yeah, well, it's easier to just put that container from the boat to the train because the international volume is really what's taken off here in the last couple of weeks. Domestic international containers tend to be more in line with trucking volumes because they're transloaded or they're held in upstream warehouses and then they move across the country. Of course, they're moving at a cheaper rate, which is also keeping them more stable than the truckload environment is as well. That's why companies like J.B. Hunt are able to kind of weather this environment a little bit more because they have a lot of intermodal. Most larger carriers have an intermodal component to them, but J.B. Hunt, of course, has a very strong one. I want to transition into the GDP, Thomas Wasson, because we had this release. This is the advanced release of GDP that we had yesterday. And there's some stuff here. The ongoing argument, like you alluded to, is the economy doing well or is it not? My take at this point is kind of listen to these numbers, but don't take them too seriously just yet because there's a lot of moving parts going on underneath. The devil is in the details as usual. The low value of GDP that we had in the first quarter, don't get too worked up about that. The high value that we're getting today, the 3% versus the 2.3% estimate, I should say, high value in relation to expectations. 3% is generally the target for economic growth year over year, but I think it beat a lot of economists' expectations because imports were down. Imports are a net negative to the GDP in general, and we had a lot of imports in the first quarter because they were getting in front of tariffs, and then we had the air pocket of imports in the second quarter, which kind of reversed that. And guess what? We'll probably have a little bit of a balancing out in the next couple of quarters. A lot of these tariff deals are starting to get inked out, so there's less reason for pull forward activity. But I think, to me, some of the underlying fundamentals of the GDP to look at, consumption figures, up 1.4%. This is an improvement over the first quarter figures. So consumers, that's what drives the American economy. Okay. 1.4% is not great, by the way, historically. 2.4, 2.5% is where we were this time last year. So we have seen some erosion in some of the fundamental data. So ignore the top level value of GDP, in my opinion, and look at some of these underlying things. Pricing up 2%. That's fine. That's a good read. That means inflation hasn't necessarily, been too excessive at this point. But imports, of course, being one of the bigger factors here. Moving into some of the other fundamental data from this, the Fed market, or some of these macroeconomic figures, we had the PCE come out, the price, consumer price expenditures, up 0.3% month over month, which was right on expectations. up 2.8% year over year. Now, the Fed's target for inflation, because this is what they use, and this inflation figure is the thing that everybody wants to.
The mandate, the inflation mandate.
Yeah, this is getting the headlines, but there's so much going on here beyond the headlines of, well, is he going to cut rates or is he not going to cut rates because of inflation? Because the reason for his tight policy, Chairman Powell's tight policy, so he says, is to make sure that we don't have too much inflation. The jobs numbers look okay. However, he still has concerns about the job market.
What type of jobs? What are the nature of the jobs?
Well, he's saying that the overall supply of labor is going down simultaneously as companies are not hiring as much. So it's keeping the figures kind of stable, like he calls it artificially, but supply is going down because of the a lot of the the deportations, the labor market's losing some participants, but also companies are not hiring because they're kind of sitting on their hands right now.
Yeah.
And we've heard that from numerous earnings reports over the last couple of weeks. So the read here is the jobs market is fine-ish. For people like you and me, we're going to be okay. There's generally, but there's not a lot of movement in the jobs market. So that makes a lot of companies less willing, like they're not going to grow as much. I think that's the read here, is that we're not going to grow right now until we get a little bit more clarity, which we're starting to see some of.
Yeah, as these deals, I mean, it does feel like the uncertainty aspect, looking at the jobs data. It's fascinating to look at those claims and then also looking at like labor force participation, because when you're trying to suss this out, I mean, the headlines have been layoffs and bankruptcies in a lot of targeted sectors. And so looking at Microsoft was the big one you mentioned earlier with cuts. Sometimes I wonder if this is part of a larger structural trend, and that's why it makes it so hard for the Fed, is do you let this thing just play out, or do you start lowering it and then you have to go back and maybe raise it? It feels extremely weird, because coming from a truckload standpoint, I'm saying capacity is still loose. We're not making any money. If you want to haul stuff, it's a great deal. But on the other side, I do kind of wonder if it's driven, if tech is having and AI is having an outsized role in some of this data for the joblessness, the CapEx, everything else. And so sometimes I wonder, just like when you're looking at stock portfolios, the Magnificent Seven it used to be, now they're changing all the names. And it's like, J-Lo and Bradgelina or something, but we're doing it with company stocks. That's one of the challenges. I do wonder if there's a bifurcation where your average consumer in certain incomes are struggling. We're cutting back on consumption, but at the same time, those higher quintiles, the folks who are in those higher level tech jobs, it's something I do wonder about.
Yeah, I think that is true. I think we've seen it in the financial markets where a lot of money, and we're going to talk about that here in a minute, has kind of disproportionately gone into some of the bigger stocks. Those are safe havens for investors, though. And as we start to get a little bit more certainty, we should start to see some of that parse out into the smaller companies. But the Mag 7, a lot of liquidity there because people trade in and out of it all the time. That's why we tend to see those kind of get overvalued in times of risk-off environments. And that's what we're seeing right now, is that a lot of that activity has been in the bigger stocks and the bigger companies. They're weathering it a little bit more. Now, the layoff situation, that's a complicated thing. We can't unwrap multiple industries here, but I think that a lot of the AI stuff, clearly they're investing in AI at Microsoft and some of the tech companies. Doesn't necessarily influence freight that much at that level, but it does bleed out. As the economy does well, freight tends to start moving. So it is something to keep kind of a loose eye on. I want to break into the housing market because this is something that Craig Fuller alluded to on State of Freight last week. And I think it gets a lot of attention because there's so much pressure on Chairman Powell to cut interest rates. What does this mean? Why do we want him to cut interest rates so much? And that's going to just magically open the housing market. I would contend that this is not just a simple rate cut issue. It is far more complicated than that because we have had a period in the housing market. First thing I want to pull up is this chart here. The 10-year Treasury note versus the Fed funds rate. It really doesn't have a strong correlation. So the 10-year Treasury note is what they base mortgages off of, basically. That's a long-term interest rate. The Fed funds rate is a short-term borrowing rate between banks. So it is a long way to go to get to that 10-year figure. It has to trickle up, if you will.
Like spot and contract rates.
Yeah. Now, you can see there at the end in 2022, they do have some semblance of a connection, more so than we've seen traditionally, and they do eventually connect up. But a lot of that has to do with other economic factors. The correlation is a little spurious because investor sentiment and investor preferences start to become, they change along with that short-term value. So if you didn't listen to any of that, the read here is that it doesn't matter as directly as you think it does on the Fed fund or the Fed funds cutting those rates, because it takes a long time for that to manifest into something where the housing market and mortgage rates start to feel that pressure.
Yeah, and that's impacting home builders. How are you going to sell and make profit off of the homes if rates are higher? That's impacting folks who are wanting to lend, if you're trying to refinance and stuff. That's one of the fascinating things they were talking about, I had read, was that the state of the consumer in relation to housing. If you had a house, things was really good. I got equity in a house. I just lucked into it since 15. But if you don't have a home, it's almost like you just missed the party. And so that's one of the fascinating things. I wonder if this 10-year yield, I also get your quick thoughts on this. Is this something deeper in terms of returning to like that 90s style higher rates, or is this related to debt and the treasuries are going up because we're worried about the volatility of some of these, $35 trillion?
Yeah, I mean, there is that concern that debt limits, of course, have been exceeded by a good amount, but that's not necessarily true here. The 10-year note gets more attention when people want to go into safer havens. Long-term interest rates, higher yields tend to be that way. We have had an inverted yield curve for a while. If you go into the shorter-term bonds, which I'm not going to get into the details here, we do actually have an inversion where there's higher yields or higher interest rate returns on these 2-month, 6-month notes than we have on the 10-year. And that's because of the higher interest rate environment that we're in currently. So it just depends on what investors are really trying to get at. Are they trying to maximize returns early or late? Are they feeling pressure of risk early or later? Where do they want to put their risk?
Where's our risk right now?
Yeah.
What would you say?
The
Long term or short term?
The T notes would say it's in the short term, but there is a growing amount in the longer term, but that's natural. Yeah. That's a natural risk that everybody kind of accepts. I want to kind of rapid fire some charts here on the housing market to kind of fully flush this out. So this is the existing home sales charts. The housing market, it's crawling along a floor. Existing home sales not doing a lot, not a lot of growth, basically flatlining. We see that coming out of the pandemic era, and I don't want you to get too excited about that drop because that's pandemic era purchasing. This is a trend that we see in nearly every demand side indicator. This is not simply a product of interest rate increases. Because if you look at this chart, about April of 2022 is when we started increasing our interest rates, the Fed fund rate. And you can see, oh, look, the Fed fund deteriorated home sales. No, this was collapsing on its own accord, and I'll show you here in a minute. Let's look at the new residential sales chart, also flat. This is going to be the home sales for anything that they just put out on the market that's brand new, flat. Again, coming out of the pandemic, another drop. Notice this pattern. Last chart I want to show you. This is going to be the OTVI versus the Fed funds rate. Look at the OTVI. Look at that. In early 2022, the Fed funds rate actually follows the OTVI. Oh, wow. So we cannot clearly state that the Fed funds rate is the reason that we have seen deterioration in home sales. Something that I've read that was really smart and intelligent based on some factual data was the bifurcation of people who owned houses before the pandemic era, and this is reflected in prices. Home prices increased at the fastest rate that we have seen during the couple of year stretch, 2021 to 2023. That pushed, all that equity. If you owned a house, you captured all that equity. Yep. Coming out of the pandemic, simultaneously, we increased interest rates. So demand is going to naturally erode in the sense that mortgage rates they started going up because of the demand for the housing, not just because of interest rates. A 1/4 point interest rate rise isn't going to hit that 10-year note for a minute. Mortgage rates increase because of demand and prices increasing rapidly. We are still dealing with anybody that owned a house. They made a lot of money on their equity, and then they're able to kind of move in and out of houses as they please. Most of the housing purchases over the last couple of years have been cash. That's what's been driving a lot of that. So if you owned a house, sorry, young folks, or people that didn't own houses, you are now trapped and wages did not increase as fast as the housing, as they never do. But I did see something on the Visual Capitalist one day that showed this relationship between income and housing prices. Housing prices have been outpacing income for years, pushing more and more of that because we leverage it. It's a mortgage. It's more about that monthly payment than the the end number. But that also means that when the housing price increases, your entry point also increases.
Yep, and the wages haven't kept up.
And they haven't kept
even
up.
afford it. You need to have two incomes now in order to afford the same house as you could in one income.
Exactly. So that's what's driving the underlying weakness in the housing, which means that even if the Fed cuts rates in September, which a growing chance that they will for some unknown reason, because everybody says the economy's doing okay, which would mean you shouldn't cut rates. There's a little bit of confusing messaging there. But there's no real reason to think a quarter point cut is going to all of a sudden open the floodgates on housing.
Because the structured fundamentals, we literally went for a point where with the pandemic, people were moving, remote work. We kind of fundamentally, it's weird to think about 5 years from now. We changed the very way that Americans worked for a short period of time. It's reverting back to it, but you can't no one's going to just let their house lose another $100,000 in equity. So we're in this weird spot. You're right. You got to hold. It's like I could sell my house. I could make $200,000 off of the equity of the home over the course of it. But the problem is like a turtle finding a new shell. When you try to buy the new one, good luck. So only the people who have the homes with the equity can put the down payments to afford it. Those of you who are entering the market, if you're a renter and you're trying to do the 10% down payment, you're at a disadvantage because someone can walk in and say, I got a boatload of cash. Let's go.
Yeah. So let's talk about tariffs and some of these earnings things, because I think these are related things. If you're looking for the influence of tariffs and inflation, look no further than some of these earnings. Now, doesn't mean they're going to show up directly in earnings because companies can, they're going to push some of these off, but a lot of these companies will just ingest the tariffs initially. Yep. I think the long-term sentiment is that they're going to start to show up. So I want to show this chart of the effective tariff rate since 1790, a long time ago. Look at what we've been doing with tariffs over the last couple of 100 years. We have not been to this level of tariff implementation, and this is just the average aggregate effective tariff rate. Look at this sharp spike.
Wow. Oh, that's us on the very far right. That little dot is where we are at. Yeah. That over 15.
Yeah, wow. we were crawling along the floor, and now we're up above 15% for the first time since the 30s.
Spicy take. Collapse of the post-Bretton Woods Agreement New World, where we were the only manufacturer left, and now we got to go back to something where everyone is caught up, and there's a lot more competition, so we can't be as generous.
Whether or not you agree with the long-term goal that we're going to bring stuff back to America, reduce the exposure to China, and all these other things, I'm not talking about that. This is going to manifest in the form of increased cost in the near term, and that's what it's going to do. It's also going to inhibit growth economically because we're going to have to adjust to all of this stuff. We were thinking about a 10% aggregate tariff rate earlier in the year. Now it's 15% on a lot of these countries. We have Korea that just came in. Vietnam's coming in at 20, unless it's coming from China, which is 40. China still hasn't landed yet. So we're going to go through this period of transition. It doesn't necessarily mean that you have to be worried about economic recession. I think that's my big takeaway here is that looking at some of these earnings calls, most of them, like we said before, are cost-controlled, produced beats.
Growth through cuts.
Yeah. Werner improved numbers sequentially month over month, mainly because they reduced their costs. They also got out of the nuclear verdict to an extent, which is huge. And then C.H. Robinson did a great job on profitability, up 2 to 3%, but it's because they slashed their headcount by 11% year over year. So we're not out of the woods necessarily. There's some cost control mechanisms going. The fact that I just told you about 11% drop in headcount at CH, yet the labor market seems to be doing okay, that's a positive sign in general. Like, I'm not trying to sound an alarm bell, but I think my biggest takeaway from all this is that we are going to go through a fairly slow growth period from what it appears like today.
But there's some fundamental restructuring as well that is settling following. We got this crazy COVID moment, restructured the first round, and now it's almost like we're putting the pieces back together to figure out what's next. So it makes it super important to listen to Freightonomics so you can see what some of those leading indicators are and some of those green shoots, as they'd say.
And don't get drunk on the financial markets. We have got some overweighted valuations right now. Costco, price to earnings ratio, 54. No. 54. Microsoft is 39.
Wow.
So tech, not unusual. Tech growth, certainly not unusual to see above 25 on the price to earnings ratio, but 54 for Costco. Unreal. JB Hunt's at a 27.
Dang.
So even in a depressed freight environment, JB Hunt is seeing what we would consider an above average return. So watch out for the financial market. A lot of optimism there that might be a little bit overplayed.
Definitely keep your fingers on the pulse. Keep your eye on the pulse, one of the pulses. But thanks so much for having me on. We'll see y'all, 2 weeks?
A couple of weeks from now. Have a great week. 2 weeks.
Great vacation.
Yeah. Thanks, dude.